Thanks for joining us today on Market Call. I'm Morella Fernandez. Michael Sprung with us on the show, president of Sprung Investment Management. He'll take your questions today on Canadian large caps. Here's how to reach us. Call us toll free at 1-855-326-6266. You can send an email in as well, marketcall@bnnbloomberg.ca. Michael, good to see you.
Good to be back.
So the war has gone on now for a month. If it were to end today, is there longer-term damage, you think, already done to the U.S. or Canadian economy?
I think there's been damage been done to the global economy. I don't think that if the war ends today, that the repercussions of the war are going to just disappear. If anything, I think it's going to take a long time to reorient not only the oil and gas industry, but industry in general. The inflationary pressures of what the war has created, I think, are going to continue for some time. And so I don't think there's going to be an easy fix. I think we're going to be in a choppy market for a period of time here.
Let's talk a little bit about the American debt load, which you have pointed to. You mentioned a few costs that are going to be added to that. Defense is one of them. Tell me about that.
Well, certainly, the U.S. is spending an exorbitant amount on defense. And, if you look at what's been attractive in the market over the last, actually for a few years now, it has been defense. So with all of the NATO countries beginning to spend more and more on defense, I think that that industry is going to continue to, get greater revenues. The question is, how competitive is it going to be to get those revenues? How profitable are they going to be? And who's going to finance them? That's another big question.
What do you see, if you do see, the fallout of the American debt load in the nearer term?
Well, in the nearer term, it's hard to tell. I mean, right now we've got the one big beautiful bill, the tax cuts beginning to come in. So if anything, I think the deficit pressures are going to get larger. And if that occurs, then the attractiveness of American treasuries might become a bit less, which will put pressure on interest rates. And so, that's going to feed right through the economy.
Okay. Let's take a quick break then, Michael. We will line up the first phone calls for Michael Sprung of Sprung Investment Management. Again, he's taking your questions today of Canadian large caps. Back in a moment. Welcome back to Market Call. Jeff has written in with a question today that we will turn over to Michael. He says, what do you think about MDA? Michael, MDA bounces around a lot, even though I know they have an incredible backlog of product that they are trying to get at. What do you think of MDA space?
Well, we don't currently own it, but it's certainly one that we've been watching quite closely. I guess from a value perspective, it's selling at multiples of book, about 3 times book, I believe. But overall, they seem to be doing very well. And, I think the PE is currently around 21 times, which is not bad given the acceleration of earnings that is expected. They're more and more into the satellite business. They just completed, I think, a critical review for the new Telesat and Apple Global Stars satellites. Now, I think there was some worry. We saw a little bit of dip in the stock price. There was some worry about the availability of chips to meet deliveries, but I think that's now been taken care of. So, if you're a long-term investor, I think you're okay. Satellite business seems to be a growing business. Last year, it was over $1 billion for them, and it comprised nearly 70% of their revenues. So I think we've got some growth going forward in MDA still. But from a pricing point of view, it's not an inexpensive stock.
Okay, that was for Jeff. Let's move on then to our first caller. Daniel's on the line in Markham, Ontario. Daniel, go ahead.
Hi, Morella. Hi, Michael. Great
Hello.
host as usual. My question is on Hammond Power. Do you own it, and what entry price would you buy it for a new position? And also, Mr. Sprung, one of the best guests on Market Call. Thank you.
Thank you for your question. Hammond Power Solutions. What do you think of it, Michael?
Yes, we own it. As a matter of fact, it was a top pick, I think, a couple of years ago, and we've done extremely well with it. Although, there was a point when it was over $200 for a while, and it's settled back from that point. But with the expansion of the electrical grid in North America, Hammond Power is ideally suited. I mean, I don't care if the electricity comes from oil and gas, coal, steam, natural gas, nuclear, whatever. It's got to be transmitted. And, they make transformers, which are in short supply. So I think they're going to continue to grow and do well. I would say that it would be really hard to time an entry price. I don't think anywhere around this level would be too bad a point, provided that you're willing to give it a few years to mature. But I think over the next few years, their business is going to expand quite dramatically.
Was there any reason it came off? I noticed it was at a high of 215. At one point, you mentioned it's now drawn back down to about 183 today. Was there any specific reason for that?
Well, I think because of the multiples it does sell at, there's a great deal of variability day to day on the outlook for how quickly is the grid build out going to go, and you have to have a place to build electrical capacity. Even with the advent of all of the data centers and the demands of AI, those power generators have got to be put in place. And I think on a daily basis, the swings in Hammond Power somewhat reflect the timing of when that's all going to happen and the timing of deliveries. But future deliveries over the long term, I think, look very good for Hammond Power.
That was for Daniel. Let's go to our next caller, Elliot on the line in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Pizza. Could I have your opinion on the company and the stock? I think of it as a dividend play. Would you know what the current dividend is for PZA? Thank you.
Thank you for the question. We'll pull up the Pizza chart there. Pizza royalty up today. Have you ever invested in Pizza or anything similar?
No, we haven't directly invested, but I have had clients come in that do own it, and I think our caller is correct. Primarily, it's a dividend play, a yield play, and so the fluctuations in pizza sort of reflect that kind of a stock, so that it's tempered by the outlook for interest rates, but also the demand side for the pizzas and their revenues, I guess, is the best way to look at it. Really, I haven't looked at it close enough to have an opinion as to its valuation at this point in time, but I know that we have held on to it for a couple of clients that did come in with it, and they've been fairly happy, collecting those dividends.
Okay, and the dividend, Elliot asked, is about 6.1 is where they are today. Let's go to the next caller. Nazar's on the line in Scarborough, Ontario. Nazar, go ahead.
Oh, hi, Mirella. Hi, Michael. Always good to see you, Michael.
Thank you.
May I have your thoughts on Chemtrade Logistics, please? This stock has been your top pick in the past, but it's trading at the present time in the range of $14 to $16. Given the nature of its specialty business, is there any chance of its vulnerability to competition?
Okay, thank you for the question. Michael, it's at 16.20 today. Mm-hmm. Is there competition in the space?
There is some, but their main specialty is in highly caustic acids that are really needed for semiconductor and chip manufacturing and so on. And the purity of those chemicals is very high. And, the recent run-up, I think, is partially, this year it's been partially due to the war in the Middle East because a lot of sources there have been cut off. And so I think that right now they've got a bit of an advantage in the market. I think they're doing quite well. We continue to own it. We continue to have a longer-term favorable outlook for it. We think that it's attractively valued currently. Certainly, if you compare it to Olin or Westlake or some of its competitors, it's trading at a fairly good discount to them. So I would recommend holding on to it. As a matter of fact, I would continue to recommend it as a purchase here.
Let's take a quick break then. We will be back with Michael Sprung of Sprung Investment Management taking your questions on Canadian large cap stocks. Back in a moment. Welcome back to Market Call. We are going to the phone lines again. Gord is on the line. He's in Oakville, Ontario. He's got a question today for Michael. Gord, go ahead.
Oh, hi, Marilla. You're doing a fine job there. I enjoy your show.
Thank you.
And hi, Michael. I'm calling about Agnico Eagle. I have a reasonable holding in it, and I'm thinking of doubling up at this point. What would you think of it as a long-term hold and a short-term hold?
Okay, thank you for the question. Agnico Eagle, like many of the gold stocks, did really well, of course, last year. Probably off a little bit now. There you go, the drop down, pullback in gold. Would you invest a short-term or long-term or maybe both?
Well, I think definitely long-term. Short-term, I think you're too vulnerable to the ups and downs in the price of gold. I mean, it has been so strong over the last year or so that really it's hard to measure on a short-term basis. But certainly the stock price is going to fluctuate to a great extent. The advantage you have with Agnico Eagle is it's really, over the last couple of years, become sort of the gold star gold company to own. I mean, this management has been extremely well positioned. Their acquisitions have been very good. Their management and operations is extremely good. So, for having some exposure to gold, and I've always said, even years ago, that having a small exposure to gold is not a bad thing to have over time. So if you're a long-term investor, I would certainly recommend Agnico Eagle.
And if you're saying a small exposure, what percentage are you talking?
Well, I like to say, on a cost basis, I would certainly keep it under 5% of your portfolio holdings. But it really depends on the person and their circumstances and what their risk tolerance level is. People who are most interested in gold often tend to be a little bit higher on the ability to take some risk scale.
Okay, 5% is the roundabout advice. Let's go to our next caller then. Joe is in Toronto. Joe, go ahead.
Hi, thanks for taking my call. Michael, I called in 19 years ago, and I had a question regarding TransAlta. Well,
yes.
Now I'm retired, and I still have a question on the same stock. Yeah, 19 years ago, I asked about the safety of the dividend, and today I'd like to ask you about going forward for the next 5 years. Would TransAlta be a good investment for a retired person?
Thank you for that question. TransAlta at $18.58. The dividend I'm seeing, Michael, is only about 1.5.
Yes, it is a very low payout, I think, on TransAlta, which from a retired investor's point of view, I think having a low payout like that, the dividend's relatively secure, and it's not a company that I follow that closely. But what I have read recently is that with the demand for greater power in Alberta, in particular. TransAlta has got a number of projects on the go, so I would expect that their footprint will continue to grow in the current environment. And I think, from a pricing point of view, I'm not so sure, but I think for a long-term retired investor, it's not a bad quasi-utility to have some stake in.
That was for Joe. Let's get to our next caller. Then Frida is on the line. She's in Chilliwack, BC. Frida, go ahead.
Hi. I would like to ask your opinion on Athabasca Oil, please, going with the present situation. Thank you.
Okay, thank you for the question. A lot of the oil stocks, energy stocks trending down, Michael, as you know, with hopes that the war will be over and that the Strait of Hormuz will reopen, but they've been all over the place for the past month. Tell me about Athabasca and if it's one that you like.
Well, again, it's not one of the ones that I have followed that closely, although I do know that on the street, a number of the analysts that I respect recommend Athabasca and have a good standing for its ability to grow from here. In particular, I think right now, as we were talking earlier, I don't think a settlement in the war is necessarily going to be a great boon for a fall in the price of gasoline in particular, I guess. But even the price of crude, I have my doubts that we're going to go back from it's around 100 today on crude. I have a hard time seeing it going back down to the 60s. And in that regard, I think Athabasca has got some great properties that they can continue to develop. And again, from a valuation point of view, within sort of similar oil sands type companies, I mean, we own Suncor, which is, of course, a more diversified company, and we own a couple of others. But I really think that Athabasca, it's hard for me to really say it's a buy or a sell at current levels.
Okay, where do you think oil will settle in at? As you mentioned, it's been around $100 a barrel, we'll say, give or take. Where do you think it could settle back at?
Well, I think it's going to be extremely volatile. A lot of it depends on, what's happening over in Europe. Certainly their demand for energy is going up and their sources of energy are in question. I think there's a lot of pressure that's going to keep oil, my guess would be above $80, but I could be wrong. The way oil is traded in the world, it can have some big fluctuations. But overall, I think the companies are going to continue to be fairly profitable. And I'm still very bullish on energy, even though there's some prospect of the ending of the war, which may or may not happen.
Yeah, may or may not happen, depending on the hour. Okay, let's get to an email from Sarah. She says, what are your thoughts on Goeasy? Michael, we all know the troubles Goeasy has been through. It did report a loss overnight, I guess, or this morning, of 336.9 to 337 in the fourth quarter. That's million. What would you do with Goeasy right now if you held it, or if you were looking at it before, would you pick it up?
Well, a company that's in flux like this is not one that I would generally jump into, and I certainly wasn't into it before it came down, simply from a valuation point of view. It participates in somewhat in the subprime loan market, and provided you're charging enough in that loan, it can be an extremely profitable business. But what happened recently seemed to come from offside, like nobody really saw this coming. And so you got to question why wasn't the market aware that these problems were building up? And so hence you see the big write-downs that we've seen today. However, they have, with their creditors, come to an agreement where they're going to be allowed to be outside of their covenants for some period of time. There is definitely a movement to allow the company to work their way out of it. I certainly know some aggressive investors that when it when it had its tumble, they jumped in thinking that it would probably be given some time to correct itself. And their loan portfolio over the year was up by some 20%. Revenues in the latest quarter were relatively flat, but this loss that we saw from some of the loans really was surprising. You do have some litigation risk with it. I mean, there have been some law firms that have been talking about class actions because they're wondering, how did this happen? How did management not see this coming? What was happening with their non-performing loans that didn't show up sooner? And if it was that material, why didn't we know about it ahead of time? But it really does appear that it's going to work itself out of the hole. I don't know what sort of multiples it's going to get going forward, but certainly it is a very inexpensive stock if it, provided that it survives over the next number of months. I think investors in it will do quite well. So, if you're asking me, I think it's more of an aggressive investor's kind of stock right now, not a sort of long-term buy and hold sort of investment.
Let's take a quick break. On that note, we will have a look at Michael's past picks when we come back. Time now to go through past picks from April 28, 2025 for Michael Sprung. Michael, at the time you chose Sun Life Financial, SLF, on the TSX. We'll have a look at where it was at that time at the end of April last year, 81.21. It is now up to 87.15, a 7% upside, 12% for total return. Do you remember why you picked Sun Life, and have you held on to it?
Oh, yes. Sun Life and Manulife, for that matter, remain two of our core holdings within the financial group. I think they're extremely strong companies. Sun Life is sort of the third largest Canadian life co by market cap with international operations. But, they're still primarily Canada, the U.S., but they are expanding in Asia in particular. They just had an announcement yesterday with respect to their alt management within Sun Life Capital, and they are consolidating that group, and that's going to be quite a large source of, I guess, assets under management for them, and quite profitable. And what's interesting about the fact that they're buying in all of the equity, they're still going to have a management equity program whereby I guess employees within Sun Life Capital will be able to participate with up to 25% of quasi-equity position, I guess. I just think that Kevin Strain has been an extremely good CEO of this company and steering it. In their last quarter, I think they reported that their underlying return on equity was just over 18%, and they seem to have a roadmap that they hope to get it to 20%. It's extremely well capitalized, and I would still recommend Sun Life at current levels.
Okay, that was Sun Life. Let's get to your next past pick from April last year, Hudbay Minerals, HBM, on the TSX. At the time, it was 10.29. It's to 29.13. So 183% return, 183% total return. They're primarily, I guess, in copper, but they do have other metals as part of the portfolio. I guess a lot of them have done well. Did you trim on this? Have you stayed invested? What are you doing with Hudbay?
Well, it was just recently in the 30s, and I guess I wish I had maybe trimmed a little bit then. But it still remains one of our core holdings within the materials sector. They're copper. They are primarily copper and gold. Their production is, in their recent announcements, I guess they've said they expect their production may be able to expand by about 30% over the next few years. well, actually, I think they said 24% to be precise. They're doing better. They're extending their mine life. They extended the life of Copper Mountain by 2 years. They're just going to come out with a feasibility for Copper World very shortly. And that is a potentially big addition for them. And the expectation is that they will sanction that property by the end of this year. So, I think that in terms of having exposure in the mining industry, certainly since it's pulled back, I still would recommend it. I think it's a good, it had its problems a number of years ago, but I think management has managed to, really grasp the reins here and turn this company around. So I continue to recommend it.
All right, that was Hud Bay. Let's get to CNQ, Canadian Natural Resources, which was your last pick from last year. A 40.86 today, recommended at today at 65.92. So 61% upside, 67% total return. Obviously, it has done well over the last month. It was pretty sideways for most of last year. Are you trimming with CNQ? What are you doing?
Well, CNQ, I think, is a core holding within our energy group. Certainly along with Sun Life and CNQ would be our two largest holdings. Again, this is sort of one of the industry benchmarks. It probably doesn't have the excitement maybe of some of the smaller cap energy stocks, but it doesn't have the extreme volatility that they have had either. Certainly energy has done well, particularly with the rise in the underlying commodity prices of late. And as we were talking earlier, they spiked well above 100 during this war. They're back around 100 now. If this war ends anytime soon, it could still go down a bit further. But again, for longer term investors, this is a great company. It's always had great leadership. It's had shareholder alignment. And, its operations are amongst best in class. And in terms of its profitability, they can sustain at a very, very low commodity price relative to a lot of their competitors because of the efficiency of their operations.
CNQ, recommended by many. All right, let's take a quick break. Michael Sprung joining us today, Sprung Investment Management. He'll take your questions when we come back. Welcome back. Let's go to Scott on the line. He is in Moncton, New Brunswick. Scott, go ahead.
Hi, Michael. Thank you very much for taking my call. I'm a long-time holder of Whitecap Resources. I'm just wondering if the recent run it's been on.
Okay, we might have dropped him. I wasn't sure if he was going to ask whether he should trim with the run-up it's had. Clearly, it's done it pretty well. What would you do with Whitecap?
Actually, in the last year or two, it was a top pick again, and we still own it today. And we would consider, I think, maybe taking a little bit of profit, but the company is doing extremely well. Their latest quarter, their volumes were ahead. They had good results at some of their properties. They're large in Montney and the Duvernay. I think they purchased Veresen not long ago, which really added to their scope and maybe is partially responsible for the increase in the market capitalization of the company. At the current price, I'm not sure that I would be anxious to jump in right away, but on any setback, I would certainly look at adding positions. But I think I'd be more comfortable down around maybe $12 if I was going to be a longer term buyer of it. But in the meantime, I still like the company, but it's, I don't. It's not one that you really own just for a yield. That's for sure.
Okay, that was Scott. Let's go to Deborah, Okanagan Falls, with a question. Deborah, go ahead.
Oh, hi, Michael. I just want to say I put you in the same legendary category as Ross Healy with your wealth of experience. So my question today is your opinion still strong on Alaris Equity, and do you have any updates? And lastly, if I may ask, what is your cash position at the moment?
Okay, Deborah, thanks for the question. Michael, can you tell us a little bit more about Alaris? I see they've got a 7% dividend, so a pretty high dividend, but tell us a bit more about them.
Well, Alaris is an interesting company, and I've followed it for a number of years, almost, I think, right from their beginning. Steve King, I think, has been an exceptional CEO of this company. It sort of began a new business where it lends money largely to private firms. Initially, that was just done through a series of participating preferred shares that had sort of bands around their ability to participate with owners. But even on the investments that they've had that haven't worked out, when they've exited from them, their exit procedures have still resulted in a very high return on investment. So I just think this is a very good company. As it is growing, it has more and more, it has more and more prospects to invest in. But a lot of that has now driven a lot of their business down into the U.S. because as they've grown, they need to have larger areas in which to invest. A few years ago, people used to complain that the payout was extremely large, which it was at the time. But, currently, I think it's down to around 45% of their cash flows. One thing that has changed is that they've also started to invest in some smaller capitalized companies and even taken some direct equity ownership in some of them. So far, that has worked out very well. So really, they're in a whole series of diversified industries, and I don't have any hesitation continuing to recommend them, even at the current price. They are still selling around book value. As you pointed out, they have a very generous yield. I think this has been a great yield stock, and our clients have done well with it over the years. And if anything, I think it's still a little bit undervalued from where it should be trading at.
That's Alaris Equity, which Deborah was asking about. Let's go to Gavin on the line in Ottawa. Gavin, go ahead. Gavin, are you there? Okay, we may have lost Gavin on the line. We'll take a quick break, then we'll come back with more phone calls from Michael Sprung in just a moment. Welcome back. Cedric is on the line. He's in Toronto. He has a question today for Michael Sprung. Cedric, go ahead. Cedric, are you there? Okay, we may have lost him. He wanted to know today, Michael, about Couche-Tard, which, as you know, tried to do a deal last year in Japan. It went sideways for a while, didn't work out with that deal. Couche-Tard is quite down. It's at 78.55 today. When you look at that chart, it's all over the place. Would you invest into Couche-Tard today?
Yes, I think I would. We do own a small position in it. To be perfectly honest, we were somewhat relieved when they did not purchase 7-Eleven in Japan last year. If anything, now they are left with a strong balance sheet, and they seem to be focusing much more on organic growth and growing their consumer stores and their fuel sales, and trying to optimize the current mix of business that they do. They have a number of opportunities open to them, they could still do some M&A going forward, but I would think it would be a little bit less ambitious than it was last year. So if anything, I think it's reasonably priced right now. It's it's not a high dividend payer, but it does have prospects for some growth. I guess the question remains as gasoline prices get more and more expensive, is that going to constrain how much of that margin are they going to be able to push through, and is that going to constrain the volumes that are pumped? So, we continue to own a small position in it. We think that it could again reclaim some of the lost ground that it's had, and within the retail sector, we think it's an interesting company.
All right, let's move to Keith on the line. Then he's in Halifax today. Keith, go ahead.
Thanks for taking my call, Michael. My question today is on Cenovus Energy. I have a position in CNQ and I own 3 of the pipelines. Just wondering, what percentage in this environment we are in now should your energy portfolio be in your portfolio? So should it be at 5 or 10, or what would you recommend today? Okay. Thanks for your time.
Thank you for the question. Does your percentage for energy fluctuate at all, or is it pretty standard, Michael?
No, it fluctuates with the market, but relative to, I guess, the benchmark indices, I believe we're a little bit overweight in energy right now. So I recommend having a good position in it, as I mentioned towards the beginning of the show. In the long term, we're fairly bullish on energy. If anything, the last couple of years has certainly laid to rest the idea that fossil fuels are dead, and if anything, they are sadly going to be needed for a number of years going forward. We still have a number of large economies in the world that are growing quickly, and the renewable energies are not going to fill that gap entirely. And I think that the demand is still going to continue to increase for a number of years going forward. And Cenovus, again, it is an extremely well-run company. As I mentioned, we have positions in, Suncor, which would be somewhat akin to it from the point of view of having oil sands exposure and so on. But overall, I think that Cenovus is a well-run company, and I wouldn't hesitate to have a position in it.
Let's leave it there then. We will take another quick break, but we have new top picks from Michael when we come back. Stay tuned. Join us tomorrow for Market Call. Richard Orell will be on the show, portfolio manager at RN Croft Financial. He'll take your questions tomorrow on ETFs. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for some new top picks from Michael. We're going to start with Vermilion Energy, VET on the TSX. Michael, what do you like about Vermilion? And you mentioned you're overweight in energy. Are you overweight in Vermilion?
Well, I think by the virtue of owning it, you tend to be overweight in Vermilion. But it's it's a interesting company. I think of particular interest to us is the fact that it, of the, I guess, domestic listed energy companies, it is international in its scope, with assets in France, the Netherlands, Germany, Ireland, Australia, as well as Canada. And, if anything, the demand for energy in Europe is growing quite rapidly. As people are probably aware, a number of years ago, in terms of energy, a lot of large parts of Europe shut down their energy generation capacity shutting down nuclear, shutting down coal generation, and so on and so forth, in almost a hopeful strategy. And generally speaking, hope isn't a strategy. And now with the problems with the wars in the Ukraine and in the Middle East, I think that they are realizing they need to have more domestic production. So I think there are some good things going on there. Last year, Vermilion made a fairly large acquisition. It was over $1 billion for Westbrick Energy. And I think just now we're beginning to see some of those synergies mature. So we expect that they will continue to expand production going forward, and that at current levels, the stock is quite attractive. They now distribute about 50% of free cash flow to shareholders. And, at current levels, it's trading near book, and it's got a yield around 3%.
Okay, that was Vermilion Energy. Let's get to your next new pick, which is Bank of Nova Scotia, BNS on the TSX. What do you specifically like about Scotiabank as opposed to some of the others?
It's relative valuation. I think that's the main attraction of BNS right now relative to its peers. It does appear to be fairly inexpensive, in terms of multiple to book value. It's only around 1.5 times. The large banks have generally all done fairly well over the last year or so, but Bank of Nova Scotia has sort of lagged in that venture. It's the most international of the Canadian banks, which is perhaps, given their exposure to South America, is part of the reason that it was held back relative to some of their competitors lately. But it still has a very strong capital base, and I think that we're going to see dividends continue to increase over time. And with a very, very strong yield now of about 4.5%, I think that it's just a good bank to have a position in for the longer term.
Bank of Nova Scotia there. Let's get to your last pick, ATCO, ACO.X on the TSX. And this is a logistics business essentially, but can you tell us a bit more?
Well, it's logistics. I mean, their main asset is probably Canadian Utilities, which has a very strong presence in Alberta in particular. But they also have a strong interest in Neptune ports in South America and some commercial real estate holdings. But, I think everybody's familiar with their sort of tin sheds that show up in the areas where there is some mining or oil and gas exploration or even buildings downtown. But that can also be extended, I think, to maybe look at some of the demand for helping with modular housing going forward. They just recently took a stake in a company called West Kittiquamot in a project to build a 230-kilometer road north of Yellowknife in the Arctic, which is going to lead to hopefully a port where ships and perhaps some other industrial equipment can go. As everyone knows, right now there's a strong need to develop the north from the point of view of people are finally waking up to the point that it could be vulnerable to foreign interests. And I think that as part of our commitment with NATO, we need to also build out and modernize the Northern Radar system and so on. Okay. ATCO is in a good position to participate in all of that, and I highly recommend it.
Michael, I got to leave it there, but appreciate you joining us here on the program. Thank you.
Thank you very much.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.